What we are witnessing are the early tremors of a significant economic shift. The data points to a gathering storm beneath the surface of the American economy, one that the public has largely yet to recognise. Corporate collapses are accelerating at a rate not seen in years. Meanwhile, former senior officials are trading public accusations over who bears responsibility for long-term strategic damage, and there is a concerted, quiet movement of gold reserves occurring overseas. Individually, these are notable developments, but analysed together, they form a coherent and concerning picture that transcends the day's headlines. Our analysis tonight focuses on three critical fronts reshaping the financial landscape. First, a wave of bankruptcies is sweeping the nation. Established firms, once considered pillars of stability, are now seeking protection as their debts mount, a sales falter, and access to credit tightens. This is not merely a culling of the weak. Even robust household name brands are now feeling the strain, indicating that the causes are structural and run deep. Second, we have the remarkably direct intervention from Treasury Secretary Janet Yellen. Her sharp critique of the previous administration's economic policies, specifically the tariff wars, argues that those actions have left the United States economically exposed and isolated at a time when it requires stability. This is not mere political rhetoric. Her statements lay bare systemic vulnerabilities that policy experts have long acknowledged in private, but which are rarely articulated so plainly for the public. Third, and perhaps most tellingly, is China's aggressive accumulation of gold. This strategic move has sent undeniable shockwaves through global markets. As central banks bolster their reserves and traders flock to safe haven assets, the price of gold is being driven to new highs. Some view this as prudent preparation, others see it as a stark warning. Regardless of the interpretation, it signals a fundamental global realignment, the consequences of which will inevitably reach American shores. We will connect these three strands for you this evening: how they interlink, why they are converging now, and what they mean for households, businesses, and investors. We will examine the early indicators that were overlooked, the patterns obscured by sensational headlines, and the tangible economic risks that are set to intensify in the coming months. Our report will also detail elements the mainstream coverage often misses: the critical role of high interest rates in pushing solvent firms toward default, the strategic implications behind Yellen's candid assessment, and the calculated purpose of China's gold acquisition. When these pieces are assembled, a clearer, more consequential narrative emerges, one of global power and financial stability being recalibrated in real time. This story is bigger than any single headline. Every element matters, and there is far more happening beneath the surface than is widely understood. The surge in corporate bankruptcies across the United States is not a random phenomenon. The pressure is systemic and coming from multiple directions simultaneously. Companies that leverage themselves during an era of cheap money are now being hammered by high interest rates, as their old loans are refinanced into cripplingly expensive debt. Many simply cannot sustain the new financial burden. Inflation has been a persistent grinding force. The fundamental costs of operation, fuel, shipping, raw materials, and wages have climbed relentlessly for years, systematically eroding profit margins from within. Even the most prudent firms now find their operating expenses are outpacing their revenue. Furthermore, supply chain fragility continues to push businesses to the brink. Whether it's an inability to secure essential materials on time or sudden punishing spikes in transport delays and import tariffs, these disruptions do more than slow production. They create profound uncertainty, forcing companies into costly, last-minute contingency plans. For a firm already under financial duress, a single unexpected delay can be the final breaking point. What makes this trend particularly alarming is its reach. This is not confined to chronically weak enterprises. We are now seeing the failure of previously stable companies. Well-known names in retail, manufacturing, and consumer goods are filing for bankruptcy because their business models are no longer viable under these new economic conditions. The hardest hit sectors are consumer discretionary and industrials. Retailers are grappling with subdued household spending as the public tightens its belt. Manufacturers face a dual challenge: higher borrowing costs and weakening demand from both domestic and international customers. The impact of this corporate crisis extends far beyond the boardroom. Every closure translates into lost jobs, diminished local economies, and unpaid invoices for small suppliers. The ripple effects harm surrounding restaurants, transport firms, and service providers. When a major regional employer collapses, it affects the entire community. The shock is also felt directly by investors. Pension funds, retirement accounts, and everyday stockholders see the value of their savings decline with each corporate failure. Compounding this economic fragility is a long-ignored segment of the corporate landscape, the so-called zombie companies. These are businesses that have long ceased to grow or innovate, surviving on a lifeline of cheap debt, servicing only the interest without ever paying down the principal. For years, historically low interest rates allowed them to endure, but the new era of higher borrowing costs has pulled back the curtain, exposing their fundamental weakness. We are now witnessing the reckoning as these firms hit their financial limit, their sudden failures sending destabilizing ripples throughout the entire market. This has created a profoundly fragile economic environment. The toxic combination of expensive debt, rising operational costs, unstable supply chains, and years of stagnant growth means that even a minor shock can push a company from stability into insolvency. And as these firms fall, the contagion spreads, with real consequences for workers, investors, and communities nationwide. The situation is further complicated by strategic missteps on the global stage. Recently, Treasury Secretary Janet Yellen issued one of her most pointed critiques to date of the previous administration's approach to China, asserting that the United States has been left more vulnerable and more isolated. This is not merely political posturing. Her analysis points to deeper structural problems. She argues that the aggressive tariff war failed to achieve its intended strengthening of the American position. Instead, it raised costs for domestic companies, fractured long-established supply chains, and weakened key industries precisely as global competition intensified. The intended pressure on Beijing often backfired, with many American firms forced to absorb the extra costs, which were then frequently passed on to consumers. At the same time, critical investment in infrastructure and modern technology stagnated, while rival nations built advanced manufacturing capacity and upgraded their digital ecosystems. The United States was mired in political debate, failing to build for the future. Secretary Yellen identifies this investment gap as a primary reason for declining competitiveness in pivotal sectors like energy storage, robotics, and semiconductors. Furthermore, a foreign policy that strained alliances has left the US with a diminished capacity to coordinate economic strategy. By distancing itself from traditional partners, Washington found it harder to present a united front on trade, security, and technological standards. The consequence? Other economies have forged new partnerships and trade routes, while the United States risks being sidelined on critical decisions, reducing its influence over the global rules of trade and making it harder for American companies to compete abroad. These strategic errors connect directly to the domestic bankruptcy crisis. A weaker international position translates into stiffer competition for US firms, fewer lucrative export opportunities, and higher operating costs. For companies already grappling with debt and inflation, this lost international advantage is the final crushing burden. From manufacturing to retail, businesses are more exposed. Those reliant on imported materials feel the tariff pinch directly, while others face rising costs and shrinking margins. Even purely domestic firms are not immune, as global economic weakness translates into higher prices and lower consumer confidence at home. In such a precarious climate, every shock is amplified. A single supply delay or a shift in currency values can be enough to push a struggling enterprise over the edge. Against this backdrop, the surge in gold prices to record highs is particularly telling. The momentum is driven by several powerful forces converging at once: rising geopolitical tensions, slowing global growth, and unpredictable policy shifts. In such times, investors and central banks seek stability, and gold remains the ultimate safe haven asset. However, this time, the most significant driver is not speculative trading, but concerted central bank demand, with China leading the charge. Beijing has been systematically increasing its gold reserves for months, simultaneously reducing its exposure to US Treasury debt. This is a strategic move that sends an unambiguous signal to the markets. When a major economic power pivots so decisively toward gold, it is interpreted as a preparation for potential financial instability or a hedge against future currency risk. Other central banks are following suit, bolstering their own reserves as a buffer against volatile exchange rates and global financial pressure. Their collective actions create a powerful, self-reinforcing cycle of uncertainty, compelling individual investors to adopt a similar defensive posture. The underlying psychology is clear. When the institutions closest to the economic data begin preparing for risk, the market takes notice. It suggests a growing concern over the long-term strength of major currencies, the reliability of sovereign bonds, and the very architecture of the global financial system. This strategic pivot towards gold has profound implications for the United States, particularly given its escalating national debt and the growing burden of interest payments. When major overseas powers begin shifting their reserves from the dollar to gold, it signals a potential decline in confidence in the long-term stability of the American currency and its debt. The US has long enjoyed the exorbitant privilege of the dollar's reserve status, but this systematic accumulation of gold abroad suggests that key nations are preparing for a future where the dollar's dominance is no longer absolute. This is far more than a symbolic shift. Should global appetite for US Treasury debt diminish, the cost of borrowing for the American government will inevitably rise, placing immense pressure on an already strained federal budget. This comes at a time when the national debt is at a historic peak, and interest payments are consuming an ever larger portion of public revenue. A sustained move away from the dollar could fundamentally reshape global finance, making the current US economic model significantly harder to maintain. This rising demand for gold reflects deeper systemic anxieties about inflation, currency devaluation, and the resilience of the international trading system. When the world's central banks begin to hedge in this manner, it serves as a stark warning. Confidence in the dollar is not the unshakable certainty it once was. When we place these developments side by side, a broader, more concerning pattern emerges. The surge in corporate bankruptcies reveals a deeply fragile domestic economy. Firms that were once considered stable are now buckling under the weight of expensive credit, persistent inflation, and unreliable demand. This exposes the underlying pressures that have built within the system, demonstrating that the foundation laid during the era of cheap money is far less solid than it appeared. Concurrently, we see a forceful critique of strategic policy. The remarks from Treasury Secretary Yellen underscore how past decisions on tariffs, chronic underinvestment in critical industries, and the fraying of key alliances have created structural vulnerabilities. These are not isolated issues. They directly shape the business environment, influence investment, and determine the nation's capacity to respond to future economic shocks. Then, layered on top of this are the global shifts. China's aggressive gold acquisition, mirrored by other central banks, introduces an external risk factor largely beyond Washington's control. As major economies diversify away from the dollar, it raises fundamental questions about the future of global financial leadership. This external pressure compounds the domestic strain, creating a perfect storm of challenges for an economy already grappling with high debt and slowing growth. Individually, these stories are significant. Collectively, they point to a system under severe stress. Internal economic weakness, self-inflicted policy wounds, and external financial pressures are converging simultaneously. It is a structure being tested from every angle. This convergence creates a highly volatile environment where a single event, a minor supply chain breakdown, a sudden shift in interest rates, a geopolitical incident can trigger consequences far greater than it would have in the past. The system's margin for error has narrowed considerably. For the public, there are clear indicators to monitor. A steady rise in corporate bankruptcy filings is the most direct measure of domestic strain. The decisions of the Federal Reserve remain critical. Every shift in interest rate policy, or even in its official language, has a direct impact on borrowing costs across the economy. The price of gold serves as a reliable barometer of global fear, signalling where the world's most powerful financial institutions believe the risks lie. And finally, the policy announcements from Beijing must be watched closely, as China's decisions on reserves, trade, and economic targets send immediate ripples across global markets. In such an environment, prudent steps are warranted. diversification of assets, an awareness of sector-specific job risks, and a disciplined follow of economic developments are not alarmist, but rational. This is not a forecast of imminent collapse, but a sober analysis indicating that the economic landscape is far less stable than it appears on the surface. Small signals often presage larger shifts, and vigilance is the order of the day. The evidence points to three converging forces: a domestic corporate crisis, deep-seated structural policy flaws, and a global loss of financial confidence. Each is a pillar of a larger story. When established companies fail, when strategic policy is openly questioned by those who enacted it, and when gold becomes the asset of choice for nations, it is more than just noise. It is, we must conclude, a definitive alarm bell.